Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley & Lardner. And today I'm here with Arthur Vorbrodt, Senior Counsel and a member of our Transactions Group. Welcome, Arthur.
Thanks for having me, Brian.
Yep, and today we're going to discuss bridging M&A valuation gaps with earnouts and rollovers. But before we get started, Arthur, would you mind just sharing a little bit of your professional background with our audience, and then we'll jump right into it?
Sure. Yeah, I started my career here at Foley in 2017. I've been doing mergers and acquisitions for the last 7 full years. I guess I'm in my 8th year of practice now. I've closed about 70 plus transactions. I'd say 75% of which are in the private equity M&A space. 25% strategics, mostly buy side work, and then sell side down the road for platform companies, private equity firms.
Well, you're a perfect expert for today on today's topic. So why don't we start out with the first question, and that's what can family offices do to bridge valuation gaps with sellers, given clearly this current interest rate environment and the economic uncertainty?
Yeah, it's a great question. I'm happy to talk about it. Given the cost of debt and ongoing disagreements between buyers and sellers regarding valuations, it would be wise for buyers to consider shifting some of the economic risk to sellers in the form of earnout payments and or rollover equity. And there is potentially actually a way to blend the two, which we can discuss later.
Perfect. So let's kick it off. First question. So what are the pros and cons of utilizing a rollover equity to bridge valuation gaps that a family office investor should consider?
Sure. Yeah. So the main point here is reducing the sort of cash burden on the buyer at closing. And you can do that through the issuance of rollover equity to the sellers. Rollover equity does come with a lot of pros in the sense that there's an alignment of interest, first off. The people that you're issuing rollover equity to are typically the people that brought the business to the position that it's in today. And they can remain invested in the success of the company and continue to have a say in its direction going forward. It also reduces the need to hire externally, sort of part and parcel, which, when you close a deal and then hire externally, that can have its own uncertainties and costs. I've found that in the past, it's much easier to negotiate, for example, employment agreements in the context of a deal or rather than in a vacuum. Right? Because you can sort of negotiate those as a package, right? Here's the purchase agreement, here's the operating agreement, here's your employment agreement. But if it's post-closing and all you're focusing on is the employment agreement with sophisticated counsel on the other side, they're going to be pushing for every single deal point that they can get. Also, not deal point, employment agreement point that they can get. So I'd say that's one of the benefits there. Again, there's a reduced upfront cash burden by the buyer, which allows the buyer to reduce the amount of finance and share the risk with the sellers. And there's also seller participation in the upside. They can benefit from the future appreciation of the business, and it provides them with a strong incentive to continue positive performance. And from a buyer's perspective, it has the unintentional value of also potentially being a reliable source of recourse against the sellers via an equity clawback in the event that there's claims under the purchase agreement, right? So you can actually use that as leverage when negotiating indemnity packages, saying, okay, we'll reduce the indemnity escrow, but you have to allow us to pursue your equity in the event there's a claim under the purchase agreement. So then going into the cons, from a seller's perspective, there's more post-sale risk here when you receive rollover equity because your payout depends on the company's performance after the transaction closes.
Right.
Differently, you can't buy a yacht with numbers on a cap ticket, right?
Right.
Something to be said about cash in your pocket at closing and a clean break. Furthermore, there's minority interest risk. If the seller, has a small equity stake, usually that means very limited, if any, influence over key decisions post-closing. So, the sellers sort of take their hands off the reins, they give it to the buyer, and it's up to the buyer to, sell the business at a profit down the road for them to receive their payday on that portion of the rollover. Also, a big point that buyers should consider is that in the event there are disputes under the purchase agreement, you now have to sue a business partner, which without rollover equity, that wouldn't be the case. Also, a small point here, and this is only in the event of really significant rollovers. If you have a rollover in excess of 40%, it could potentially affect your coverage under your rep and warranty policy if you're using a rep and warranty policy for your transaction. So you'll just want to keep that in mind as well and speak to your lawyers. Also, open with rollovers, you open negotiations for terms of put rights and call rights and equity forfeitures and so on and so forth. So the inclusion of rollover equity in your deal will likely increase the complexity of the transaction documents and the costs incurred in negotiating the deal itself, because there's just another element of seller ownership that you now need to take into account for post-closing points.
Got it. So let's look at the flip side, of the coin. And what would be the pros and cons of utilizing earnout payments to bridge valuation gaps for that family office investor that they should consider?
As you can imagine, there's quite a few similarities between rollovers and earnouts in terms of tangible and intangible pros and cons, such as risk sharing, right? Similar to rollovers, it helps mitigate the buyer's risk in the case business doesn't perform as expected, right? Allows the buyer to meet the seller's valuation, saying, okay, put your money where your mouth is. We will, we'll pay, but you need to hit certain metrics over the next year, 2 years, 3 years, 5 years. Again, there's the same incentivization as you'd see with rollover, right? The seller is incentivized to stay around, stay involved, and help the business succeed. Another benefit to the sellers is that earnouts typically have a shorter time frame than rollovers, right? Where the typical PE exits, 3 to 5 years. Earnouts sometimes are payable the next year, right? All you have to do is hit EBITDA for 1 year, and you get your payment, and you then get to go buy your yacht. Again, similar to rollovers, the pros of an earnout to the buyer is that there's also a source of recourse going forward, assuming that the earnout is in fact hit. That recourse being a clawback or a set-off against the earnout payment obligation when it arises. So put differently, if an earnout payment is due, but also the sellers are required to indemnify a buyer for losses under the purchase agreement, then the buyer can set off those losses against the earnout payment that's paid to the seller.
Well, definitely complexity on both sides. And you did mention a third option at the beginning of our discussion that combines both the earnout style incentives with the rollover equity. Can you just elaborate briefly on that with our audience?
Yeah, sure. So another option would be to issue rollover equity, the retention of which is subject to satisfaction of future performance metrics, right? Similar to earnouts. So put differently, if the company doesn't perform as expected, then the seller's rollover interest would be proportionately reduced. Another tweak to this would be to issue additional equity if performance targets are hit, right? So I guess on one hand, you can issue all of the equity and it's subject to being clawed back, or you can issue some of the equity and it looks more and more like an earnout, and except it's payable in the form of equity as opposed to cash. Right. So I would say the pros to this method are similar to rollover equity, right? You have an alignment of interests. You have a source of recourse for breaches on the purchase agreement. Plus, you have the reduced cash burden at and following closing. Finally, it allows for future participation in potentially lucrative enterprise, right? If you're part of a business that is hitting its, sometimes aspirational EBITDA targets, maybe you see more value in being able to invest in that enterprise and your post-closing payment being payable in the form of equity in that business that is doing better than everyone expected to do. Then on the other side, the cons here, I'd say, are similar to the earnout, right? There's this complexity in negotiating the various definitions, your objective metrics, what is included, what is not included, this sort of inherent tension between the buyer wanting to run its business and the seller wanting to get paid, and the various negotiations that surround that. Plus, to some sellers, I mean, it could be less attractive than cash at closing, right? Again, you can't buy a yacht with illiquid equity.
Right.
And if equity is to be issued in the future, there will likely be disputes about the value of that equity when it's issued, right? Is the price per unit the price at closing, right? Is it $1 per unit, or is it the then current fair market value, right? Which would then implicate valuations. Who performs the valuations? Who pays for them? Who walks away the winner if you use the price at closing versus a later price. Again, all things that you should consult your lawyer about.
Well, certainly a very complex area of the law, and counsel is extremely important. In just closing here, is there anything else you'd like to add?
I would say that, if a buyer is contemplating utilizing contingent consideration in their offer, the material terms that we discussed earlier should be negotiated and agreed to in the pre-LOI / LOI signing stage.
Okay.
There's a lot of business points in a given transaction that could be considered immaterial or otherwise left to the post-LOI negotiation period. I suggest picking up the phone and having a conversation with your lawyers about memorializing the details of any earnout or rollover or blended arrangement prior to signing the LOI. Many of the points we discussed are not really legal in nature, and disagreements with respect to, say, restrictions on post-closing operations of the business, for example, could have real financial implications on the buyer's valuation. And you'd want to get way ahead of those sorts of issues before you run into a material disagreement shortly before closing.
Well, Arthur, I want to thank you for sharing your valuable insights today, and I want to thank all of you for watching our presentation. For more information, please visit us at Foley.com under Family Offices. Thank you.
Thanks, Brian.